Hi, and welcome to this week's market presentation. Price evolution. The price evolution over the past week showed minimal movement across oil and LPG markets. However, natural gas and electricity prices saw notable gains, especially over the coming months and through the end of 2026, with the most notable gains during the upcoming summer months. Latest news. Looking at the latest energy news, we see that the US-Iran indirect peace talks in Doha have continued to maintain the recovery in commercial transit through the Strait of Hormuz, with crude oil flows now returning to pre-war ranges of over 10 million barrels per day of oil flowing. The continued flow of oil and the easing of tensions following some hostilities the week prior has pushed Brent futures below $71 a barrel for the front month as the geopolitical risk premium continues to fade. Now that we are seeing those physical flows return to the market participants and financial institutions are now shifting the focus to a potential oil glut, with additional supply now expected to oversupply crude oil markets globally, adding to the bearish pressure on the market. The prompt contango structure further deepening on the easing tightness in the market. Over in the European Union, European carbon prices have been exhibiting highly volatile trading sessions, with prices around the €80 per ton benchmark as participants brace for the upcoming EU ETS reform proposal. A draft report that was linked to the press from the European People's Party suggested slowing the linear reduction factor, or LRF, to provide more free allocations and ease industry costs. The release of those drafts briefly pushed the December 26 product below €80 per ton before quickly recovering above that price level once it was clarified that no emergency safety clause or free permits would be proposed for the power sector, reducing much of the bearish hope in the market. Compliance buyers, however, remained cautious amid policy uncertainty. The European Commission is preparing to publish its more comprehensive and mandatory EU ETS review by mid-July, which will add a significant regulatory focus to the market over the coming weeks. And then lastly, for the latest news, energy ministers of the United States, Qatar, Nigeria, and Algeria have sent an open letter warning that the European Union's upcoming methane regulation, which would introduce compliance penalties for importers, could severely disrupt Europe's oil and gas supplies due to what they're calling unachievable compliance timelines. 17 EU member states have formally urged the European Commission to revise the rules, pointing out that crucial implementing acts, delegated acts, and monitoring standards are still not in place. The European Commission is reported to be drafting a recommendation inviting member states to suspend compliance penalties for importers from 2027 through 2029 on contracts signed or renewed by 2028. Strict enforcement of the new policies could potentially add significant risk to the EU gas supply security. Non-binding waivers are then in turn creating legal risk for importers who could face a lack of a uniform legal enforcement across the 27 EU members, adding to overall uncertainty, regulatory, and price to the market. Weather. Moving towards the latest weather forecast, we highlight the persistence of above average temperatures across Europe over the next 7 to 10 days, particularly in France, with temperatures through the middle and end of this week as high as 12 degrees Celsius above seasonal norms. Precipitation will remain limited across most of Western Europe over the next 7 to 10 days, although the Nordics are expected to see some precipitation throughout the next 7 to 10 days. Wind speeds are picking up through the beginning of this week, particularly across Germany, and overall expected to lead to a boost in wind power generation through the beginning of the week before seeing some slower wind speeds through the middle and end of the week. Microeconomics. The latest microeconomic indicators for PMIs were released for the month of June, which showed the composite PMI for the euro area improving over the past month, up 1.5 points to 50 points. Over in the US, we saw another improvement there, up to 52.2 in what has been welcome news regarding the PMI figures on these economies. Taking a closer look, we note that on the manufacturing sector, we've seen a slight decline in PMIs across most economies, but particularly looking at the US and the UK. The euro area seeing rather minimal movement of negative 0.2 points. On the service side, however, is where the euro area saw the biggest gains, up 1.7 points over the past month, surpassing the gains seen in both the UK and the US. Japan, on the other hand, leading the way with a 2.2 point increase. Inflation for the euro area for the month of June is down 0.4 percentage points, down to 2.8, with core inflation down to 2.4%, likely driven by the easing of energy costs through the second half of the month, but overall moving towards a positive movement down closer to the 2% target set by the European Central Bank, potentially reducing the probability of additional interest rate hikes at the ECB's next meeting. Crude oil and LPG. Moving next towards crude oil prices, we note the minimal movement over the past week, although nonetheless still seeing a new bearish price evolution following the active phase of the war in Iran, as the ceasefire and negotiations are ongoing. U.S. crude oil stocks continue to be used as the market reacclimatizes to the return of physical flows through the Strait of Hormuz. But in the meantime, the still tightness of the physical market still pushing consumers to rely on crude oil inventories. Natural gas. Moving towards natural gas markets next. Here we note the upward movement over the past week, most notably felt over the coming months and through the end of 2026, with the front quarter now up 9.4% on the week. The frontier up 4.3% on the week. European gas storage levels saw limited increases over the past week, with the comparison versus last year widening further as the injection rate into storage falls behind that of not just the average over the last 13 years, but also below the levels we've seen over the last 3 years. European gas storage levels are now risking entering the winter season at 5-year lows, adding to the concerns over the security of supply. The driver of the smaller injections largely due to a decrease in total supply over the past week, even as total demand eased as well, on the back of the end of the heat waves that had hit Europe hard over the previous week. The European gas supply mix continues to see near record high levels of Norwegian gas flows to Europe, which are helping to compensate for the further decrease in LNG sendouts, with LNG sendouts now falling to a new 4-year low and below the average since 2019. Investment fund positions saw a further decrease in long positions, pushing the level of net long positions now to the lower levels we saw prior to the start of the war in Iran. Coal. Moving next towards coal markets, coal prices saw slight gains over the past week for the frontier, most notably in the API 4 index, which was up nearly 5% on the week. ARA coal stocks in Europe remain at elevated levels, in part driven by the lower water levels at Cub in the Rhine, which are limiting transportation of coal from ports to power plants. Over in Asia, we are also seeing a decrease in coal imports from China by Russia, potentially opening additional supply to other countries. Overall, the heat waves in Europe that spiked power demand certainly added to overall coal consumption there. But overall, the strong performance of renewables, as well as the decreasing price of natural gas, easing the demand for coal, particularly from the power sector. EU and UK emission allowances. Moving towards carbon allowances saw a slight decrease in the spot market for the European side over the past week, but overall limited movement over the past week for both the EU and UK carbon markets. On the UK side of things, the UK ETS is considering including maritime emissions as part of the scheme, which could potentially increase the overall demand for carbon allowances, adding some tightness to the market. On the European side, as mentioned earlier, the regulatory environment and uncertainty of what policy changes will be introduced are very much moving the market at the moment, with moments of more bearish pressure on the market. Overall, we certainly will have to keep a close eye on what the European Commission reports and publishes, as market participants keep a close eye on those potential regulatory changes. Power sector emissions, as we can see here, very nicely tracking the weather temperatures that we've been having. That spike in overall emissions driven by the severe heat waves across Europe, pushing up demand for fossil fuel power generation, and see those emissions coming down once again as we see those temperatures cool down, especially as we see an uptick in non-emitting sources of power generation. Overall, EU carbon allowance future position saw an uptick in long positions, once again pushing up the level of net long positions. But on the UK side of things, we've seen those stabilizing over the past week. Electricity. Looking next at electricity prices saw an uptick in the price level, especially over the coming months and through the last quarter of 2026, which saw an increase of just over 5% on the week. The decreases were more modest for the frontier, up just 2.5%, and minimal further along the curve. The price evolution was similar across other European markets, with increases over the past week for the frontier in both continental and also in the Nordics. Looking at total grid demand decreased over the past week after pushing total grid demand to a new 5-year high due to the heat waves that swept across Europe. During those heat waves, we saw an increase in the residual load as the grid depended more on fossil fuel power generation in particular. But nonetheless, non-dispatchable, particularly renewable power generation, has remained performing at a record level with output over the past week at a new record high for this time of year. Taking a closer look at non-dispatchable supply, we see that uptick in wind power generation. And while solar power generation saw a sharp decrease along the same time frame, it is still at an all-time high so far this summer. Looking next towards residual load, which has eased down over the past week as total grid demand has decreased, we see the impact that the weather has had on the demand for fossil fuel power output. But we're also starting to see a return or recovery of nuclear power generation, particularly looking at the French nuclear power fleet, which has seen those river temperatures come down. And as a result, we are seeing those environmental reductions in output easing off, with output returning to pre-heat wave levels. Lastly, hydro reservoir levels remaining near 5-year lows as hydro storage levels remain at poor levels, particularly in the Nordics. And lastly, looking at the guarantees of origin, we note more limited movement over the past week as markets relax following several weeks of significant movements from one week to the next. Prices continue to be supported by persistent Nordic hydro deficits. However, when we look at the supply of solar power generation in particular, with Spain, for example, reaching a record level of curtailments, we're certainly seeing a bright outlook on the demand side, on the supply side of things. On the demand, however, we still see strong demand with several auctions over the past week clearing all available supply at elevated prices compared to previous auctions. So again, indicating the strong demand for guarantees of origin in Europe. That covers this week's market presentation. Thank you for joining.